to why I stated and have been correct that Bitcoin would see massive resistance at the $30,000 to $31,000 level, right? So if we go to the Bitcoin chart, which is where we are now, and I zoom out, and let me flip over here. Here's your Bitcoin. I'm even going to go to the weekly here so we can see it a little bit better. But that's why this level here is such a major resistance, because you had all these people buying in here. They were in the money. They didn't get out. They watched it come back. And by the way, up here, when we were at 69,000, think about it. What was the mentality? I saw posts galore. Oh, by the end of November, this was October, by the way, when it made the high, we're going to go to 100,000 and then 250 and so forth. So everyone was so bullish. The bottom fell out, hit here, broke. Now you have all these people exiting and saying, oh, well, now I'm back to break even. I'm going to take my money off the table. It's a very normal psychological thing. Okay.
Hello and welcome to Money Talks. In today's video, Gareth Soloway gives us an update on his current macro thesis and his perspective on current global market conditions, also his prediction for Bitcoin and crypto, and where he thinks the market will go in the next months. So let's get started with the video.
I want you guys to understand a couple big events that occurred overnight. Number one, Japan did another bond buying program. Now, what's so mind-blowing about this, and we've just come after the debt downgrade by Fitch, where the U.S. debt got downgraded. But we know from last week that the Japan basically was saying, hey, listen, inflation is so high, we can't artificially keep rates at essentially zero. We need to let them float up. The problem is this. Check this out. When they started to loosen control of the yield curve, yields began to spike too aggressively. And again, this is what happens, is governments try to control this crap, and when they loosen up, it begins to spike back to where it's intended to be, where market factors are showcasing that it should be. And what we're seeing in Japan is that they have so much debt to GDP, they have so much debt, all these issues, plus inflation, is that yields in Japan should be much, much higher. And so to keep yields from spiking too much and just raising them a little bit, Japan is having to do bond buying. And remember, bond buying is essentially flooding the market with money. And this is going back to what the Fed will eventually have to do. The Fed will eventually have to do this as well. They're going to eventually have to print money. Now, Japan's not going back to print unlimited money. They're just trying to control the yield curve. And it's literally like playing with a lit bomb right now. I mean, like if they don't do it right, you can have a blow up, which, by the way, the market's starting to tell us. If we look at the VIX spiked yesterday. We know the market sold off, right? There's a debt bomb, and I've said this for a long time, is when you have countries that have debt to GDP where they are, like the US and Japan and much of Europe, this is problematic. This can't go on forever. And when you have inflation, that's when you have trouble. When there's no inflation, you can do it. You can print unlimited. I mean, think about MMG, modern monetary theory, MMT. The idea here was that governments can print unlimited amounts of money. This was somehow believed by economists over the last 10 years, as well as a lot of politicians. And politicians are idiots, frankly, most of them at least. So that's not even a big deal. But the economists, that was always surprising to me. Because how do you think that a government can just print unlimited and there's no repercussions ever? There is. If there's a repercussion for my household, the U.S. or Japan or all of these countries, they are just a bigger household with more individuals under one roof. Okay, so that's one of the keys here, guys. By the way, the big thought process, and I've said this, you kind of have to crack up sometimes because, people kind of say, oh, you're crazy, inflation's coming back and sub 2% and the Fed will be able to do this. And I'm like, no, inflation's going to stick around 3%. It's going to get sticky at 3%. And now all of a sudden, Bill Ackman did a tweet last night, one of the big hedge fund managers in the world, by the way, saying that he's buying he's basically shorting long-term bonds because it expects long-term rates to spike dramatically higher.
On August 1st, a significant event occurred within the financial world. Fitch, a reputable credit ratings agency, lowered the credit rating of the United States government from the pristine AAA to AA+. This downgrade signaled diminished confidence in the U.S. government's ability to handle its fiscal responsibilities effectively. The downgrade nudged investors into a cautious stance, leading many to move their money out of assets like stocks, silver, oil, and long-term bonds. Instead, they favored cash and short-term instruments, which are perceived as safer options in uncertain times. As evident from the chart, the reaction to Fitch's decision to downgrade the U.S. government's credit rating was broad-based, affecting commodities, fixed income, and equities alike. This has implications for various financial institutions and investment portfolios, including Bitcoin traders, are now contemplating if Bitcoin's digital scarcity and censorship resistance can offer refuge from the widespread flight to safety movement instigated by the deteriorating credit score of the world's largest economy. The resilience of credit default swaps for U.S. Treasuries and the strengthening dollar, as per the DXY, suggests that investors might be enhancing cash holdings in anticipation of market turmoil. Consequently, Bitcoin might not immediately thrive from the U.S. government's debt profile downgrade. The initial flight to liquidity often overlooks the benefits of decentralized assets during early market turbulence. Given Bitcoin's digital scarcity and fixed supply, it stands out as a valuable asset amid expanding government debt, which can depreciate cash. As a result, investors may increasingly consider Bitcoin a safe haven and a robust asset class that is resistant to censorship due to its decentralized nature.
Why isn't the stock market back to October lows, which is down, 20-25% from where we are? Just saying. Now, listen, there are some differences, right? I mean, you could argue that inflation isn't as high as 9%. That's true. But again, if we see any sign of, and this is the kicker, any sign of a slowing economy, meaning a potential recession, if that happens, and by the way, jobs numbers have remained strong. ADP yesterday was strong. Jobless claims today stayed low. Everything's looking okay. Jobs report tomorrow is going to be key. But if we see a recession on the horizon and you still have inflation at 3%, watch out, because the markets will react and flush. And by the way, just going back to the 10-year yield spiking, one of the big issues here, guys, is not only that the U.S. has 32.5 trillion in debt, 1 trillion essentially in interest payments, but a lot of companies have debt that's now rolling over, and they're going to be essentially refinancing or redoing that debt at current levels versus 1% what it was. We're now looking at 5-6% type renewal of corporate debt. And that, again, is going to be a huge drain on earnings over the next few years, because there's a huge difference when you have $10 billion in debt, which so many companies do. If you're paying 1% on that debt on a yearly basis or 5 or 6%, think about that. For those of you that have bought a house recently, think about the difference between what you would have paid at a 3% mortgage. Now you're paying 7 to 8%. Huge, huge monthly different payment. So again, storm clouds, and again, flipping back here, guys, storm clouds continue to brew. I've been warning about this. I'm not going to say that this is the beginning of the collapse. I'm not going to say that this is the exact high. We'll find out. What I am telling you is that over the next 6-12 months, things are going to get tricky. And as long as you've been following me, you know that I've been warning about this. And I want you guys, even if you say, screw Gareth, forget it, I'm going to go long the markets, I'm going to go long every big tech stock out there, that's fine. I just want you to have a balanced picture, because this morning when I turned on CNBC, and again, you guys know my point of this show is to not be mainstream media, not feed you guys the same crap that they're seeing. What did I hear? Oh, Warren Buffett said, don't worry about the downgrade. Jamie Dimon said, don't worry about the downgrade. No big deal. Don't worry about it. Okay, well, why? Well, let's look at the data. What's the data showing? And the data is showing a insanely different picture. Now, why would Jamie Dimon and why would Warren Buffett say don't worry about it? Well, imagine if Warren Buffett came out and said, holy crap, we're screwed. I mean, think about the collapse that you'd see. So and not only that, but they have investments. The bank, JP Morgan has a ton of commercial real estate that's probably worth almost zero. If they cause panic, what happens to the banks? What happens to JP Morgan? You have to look at the underbelly of why they would be sowing the seed of relaxation and no big deal. It's not as simple as like, oh, they truly believe that. It's more like there's these other factors that are making them say that.
So, what's your price prediction for Bitcoin at the end of 2023? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.